Do you know what time it is? Are you excited for the season right now? It is tax times. I know everybody's favorite part of the year. These are 10 things that you can actually leverage for 2023 to help reduce your taxable income and put more money inside of your pocket. Number one, giving to charitable organization. Also, if you can give old stuff to Salvation Army, Savers, Goodwill, you get $500 for each one of these that you can deduct automatically. If you get them itemized, then of course you could deduct a lot much more from each one of these. Number two, retirement. Contribute as much as you can to your 401k. As an individual, you can contribute up to $22,500, as well as self-employed on the employee side. But if you are a business owner on the employee side, you could put a lot much more, up to $66,000 for the year 2023. If you qualify to contribute to an IRA, because it's based on income limitations, you could put up to $6,500 for 2023, and if you are over 50, up to $7,500. And HSA is another option. You could put up to $3,850 for 2023, and if you're over the age of 50, you could put up to $4,850. For both the retirement and HSA, you have until the tax filing to make the contribution. So even if you file taxes, let's say in March, you have until April 16th to actually give the money to those particular accounts to contribute it, that it's there. It's just you're letting the IRS know this is how much I'm putting in, but you have until April 16th to actually put the money in there. If you don't, then that's when you get into trouble. If you do not qualify for an HSA, you have the FSA option. I don't know much about it because I never had to do that. The HSA was always available to me. If you had crypto stocks that you sold at a loss, you could deduct those from your taxes. It's beneficial only, I feel, if you had gains of stocks, crypto, inside of that year. Because if you don't, you are capped per year on how much they're actually gonna give you back in credit each year. So if you had $50,000 in net loss, meaning if you made $75,000 from stocks, crypto, you lost $100,000, you add a $25,000 loss. You cannot claim the full $25,000 that full year. If you only lost like $50,000 and you made $75,000, then you had a gain of $25,000. You're only going to pay taxes on the $25,000. I do strongly encourage, though, hold your crypto stocks for 1 year or more, so that way you're not paying the ordinary income taxes on your stocks and crypto gains. You're paying long-term capital gains, not short-term. Hold your home for at least 2+ years and make sure you have lived in it for 2+ years so you can enjoy the benefits of the $250,000 tax credit if you are single, because you're only required to live in the home in 2 of the last 5 years. You get this $250,000 tax credit. So let's say you bought the house for $500,000. You're selling it for $750,000, then you pay no taxes on the capital gains. Your cost basis is a whole different factor because it takes into account improvements you made to the house and everything, and that number would increase your cost basis, right? So you might be able to go to a higher number, but those are more complicated things. I just want to make sure you understand how it works and the logic. If you're married, you actually get up to $500,000, $500,000. So meaning if you bought the house for $500,000, you're selling it for $1 million. Instead of paying taxes on the full $500,000 in difference, right? From $500,000 to $1 million is $500,000 difference. You're only paying taxes on nothing because you're married, right? You get this tax benefit and you lived in it for 2 of the last 5 years. If you have home repairs that you did because you rented the house, you could deduct those. You also don't forget your home depreciation tax credit. So that's based on the value of your home when you purchase it. The IRS tell you to divide it by 27.5 years. That's just a free credit that you get for doing absolutely nothing as long as you're renting part of the home. And you only get it on the rental portion. Meaning if you're supposed to get $30,000 for the entire home, and you're only renting one side of the home, like it's a 2-family, then you're going to get only half of that, which is $15,000 in credit each year. That's pretty much my situation. If you're using part of the home for your business, that's something you have to speak to your accountant about. The home office deduction lets you deduct a portion, like 10-20% of the home from your taxable income. And then you have the Augusta rule, which really applies if you rent out the home for 14 days out of the year, you charge a premium to your own business, to yourself. That's when it's beneficial. But some certain factors, like for me, it was the utilities. The utilities exceeded a certain amount. It made more sense for me to go that route instead of using the Augusta rule. If you have just started a business in 2023, then I'm sure you have losses and you made no profits. You can actually let that bleed into your W-2 income and your 1099 or corp-to-corp income. There are some limitations once you pass a certain income threshold. The accountant will tell you that because it's based on amount of different factors. The last of the 10 is gambling. If you have gambled, made a lot of money from lotto tickets or going to the casino, I'm sure you had losses because no one just gets straight wins from the casino. They'll look at you side crazy, and I'm sure they would probably have kicked you out. They want to see you actually do some investments. I'm telling you, it's rigged. You can actually offset that with the losses, so that way you're not paying capital gains on the full amount, but a portion of it. So if you spent $10,000 on gambling and you made like $25,000, you're only going to pay taxes on the $15,000 difference. I started getting the anxiety probably after the end of January because that's when I get all the documents, the 1098 statements for the home, 1099 statements for my company, all the royalty statements. Everything just starts coming in after January 31st. And then I got to put all this stuff together and everything. And that's where I start panicking. I'm like, oh, shoot, I only got a couple of months. We have until April of 16th of this year, 2024. Some of this, it had to be transactions that you did last year in order for this to qualify. But some of it you have until your filing date or up until April 16th to actually incorporate this inside of your tax return filings. Given has definitely done a lot for me in my life, and it forced me to build certain habits and disciplines which I think really helped me in business. Principles that really the Bible provided. Giving really force you to be a certain way when you do that. Give a portion of whatever's in your heart's desire. Don't stick to the 10%. If you see my last week video, that's what I was talking about. But that's my own perspective, right? If you want to do 10, 20, if you want to set targets for yourself, do it. But do it according to your own heart's desire. What happens is the IRS, they give you credits when you do give to charitable organizations. And two, that you could just give by getting rid of old stuff. Did you know that Salvation Army, Goodwill, Savers, all these thrift shops, right? You could just give stuff away to. You get that tax slip that they give you, that piece of receipt of goods. You could get $500 for each one of these without itemizing anything at all. For you to get more, you would have had to have an itemized document from the company in order for them to actually evaluate what you were given, the actual cost of it. Like when I gave a car to Car for Kids, initially I was supposed to just get $500, but they actually gave me a valuation of the car's worth. It was $800. It was between me getting $100 for the dealership. It was an old car, 2004 Saturn, but it was still running good. I had it for like 5 years. But when I got to the dealership buying a new car, they were like, yeah, we'll give you $100 for this. I'm like, just $100 for this car, and plus I still have, the $20-something thousand financing. It didn't make sense. So instead, I got the valuation from Car for Kids, donated, they picked it up and everything. I don't have to do anything. And at the end, close before the year was over, they gave me the $800 and change tax receipts, which I got $800-something of deductions for, which is great. Better that than you have an extra $100 in your pocket. You reduce your taxable income by $800. The savings is going to be at least $300, I think, for me. That number can vary based upon your income and how much you brought in for the year. Plus, you're helping causes. You're helping structure the economic society in a way to organizations that are benefiting or changing the landscape of how it functions. That's why I do encourage to do that rather than give it to the government and then they'll go spend it on some wars, weapons, of whatever they do. The reason retirement is a big thing. One, yes, of course you get to 59 and a half. That's when you can start doing the minimum required distributions, and they force you to do it after 72, 73. And those numbers, they can change. You are going to need a lot in retirement because you're not going to be capable to move around as much as you were when you were in your younger days. Like, I'm looking at myself right now, I'm like, man, I can move, I can think so much and everything, but I need to go 120% right now, 200%, so that way by the time I'm like 40, I could just be done. My retirements have been building up quite a bit. The next bull run that happens, I'm looking forward to it. I'm going to feel pretty good by the grace of God, of course. Whatever money you put in now, you could allocate it to either 2023 or 2024. The smartest thing to do, of course, so that way you could pay less taxes for 2023 is put it towards your 2023. If you did not already maximize it, you could put a maximum of $22,500 as an individual. So whether you're a business owner or not, you're just getting W-2 income, you could put away up to $22,500. on the employee side, right? Regardless of how much you made. Now, on the employer side, and this is only if you own a business, self-employed, and set up your retirement structure in that way. Like for me, I have a solo 401k, so I could usually get up to close to the $66,000 total that they allow you to, but it's also based on your income. So you can only contribute up to 25% of your net profits, minus certain calculations I'm not going to get into, but the account will figure that out for you. And you could do the same thing on the Roth side as well. But if you do the Roth, you're not going to get the deduction. I always say, for me, if you have money that has not been taxed yet, put it into the untaxable vehicle, right? But if you have money that's post-tax already, then of course it makes sense to put it in the Roth in that situation. Of course, there's the backdoor side of it, which I'm also contemplating. The 401k account, which I use part of it to purchase my first property, I'm almost done paying off the loan, and the value of it is going to be around like $110 by next month, right? Assuming the market goes up, it's going to be higher. I could roll it over into a Roth IRA, do that whole backdoor situation, pay the taxes, and now I have a Roth account, which will probably have, I don't know, maybe 70,000. Depends on my tax numbers. That's something I'm going to work out with my accountant. What that does is when I am 59 and a half, when I can take out the distributions, I pay zero taxes on any of the gains from that, right? I want to have a bit of diversified. What I'm thinking about is having diversified assets that I can tap into. I have my regular 401k, which the only way to offset the taxes on that is buying more real estate, having more businesses. Then you can offset the taxes that you would pay on that. But when I'm 59 and a half, am I going to be thinking about all that and stuff? Am I going to have the structure to be able to do all that? So I may, because at that point, I want to have my corporation set up and just be hiring people to manage all this stuff. And I'm just making strategic decisions. The advantage to the Roth is I don't have to think about all that. I have access to all my money now. And for me, that's in another 30, well, a little less than 30 years. I got a little older now. But I'll have access to that, and I'm like, oh, this is great. Now I can get this tax-free money. I can do whatever I want to do for my regular expenses. But when it comes to business investments, that's when I'll tap into the regular 401k, because those I can reduce the taxes in that sense. So you have those two fluctuations. The IRA in 2023, the limit was $6,500. Of course, it increased for 2024, but we're not focusing on 2024 right now because you'll be filing taxes for that next year. If you are over 50, actually, you can contribute another $1,000, putting you at $7,500 for the year in tax deductions that you can get for your IRA. If you chose to do a Roth IRA, you don't have the deductions, but at least you could put all that money inside of the Roth IRA. I really wish that when my income was much lower, I did put away some into a Roth IRA, so that way at least I had that. But it's really not too late. We'll be paying a lot more taxes if I do this conversion. I really wish I did that. So I really encourage you, if you're under that income threshold and you are able to put into a Roth IRA, do it, max it, because it's not as much, right? It's only $6,500 that you could do. Roth 401k is a different beast on its own. It has a bigger limitations. Whether you will go that route, it's really totally up to you. That's something you got to work out with your accountant. The HSA, it is a great vehicle that I've been using because you could make medical expenses on there tax-free. It's another way for you to have a Roth, but really you don't have a Roth. And I believe when you get older, you can take out whatever you don't spend, a portion of it, but it all has to somehow tie to medical expenses. So that's why I'm putting money inside of the HSA right now. The value of it right now is around like $16,000. I started putting money into it since 2018, max it out as much as I can. The market has been growing. At its peak, it was valued probably at 30-something thousand. So I'm really looking forward to that account being a six-figure asset itself. The limit in 2023 was $3,850. And if you are over the age of 55, you could put an additional $1,000, which is $4,850. If you do not qualify for an HSA, you have the option of an FSA you can look into. The FSA is similar, but I don't have one, so therefore I'm not going to give you all the ropes around it. To many of us who have crypto stocks that we probably sold last year, if you sold it before December or on December 31st and it was at a loss, you could actually deduct those losses against your taxes. There are some limitations and such, like they don't let you do the whole thing all at once in 1 year. But if you have gains one place and you have losses in another place, you can offset that. If your total net, right, your net, meaning after all your gains and all your losses, they equate to negative 50,000, they're not going to let you take all that in 1 year. You have to depreciate it over a certain amount of time. For those of us who are homeowners, if you had your home for 2+ years, lived in it for 2+ years in the last 5 years. This was a very confusing one because I have a friend of mine who was going through this transaction and he also wasn't sure if he qualified for this. But what it is let's say in 2020, you lived in the home. 2021, you lived in the home. 2022, you moved out, rented it out. 2023, and then here we're on 2024. You're trying to sell it now. Yes, you qualify for this, right? Because within the last 5 years, 2020, 2021, 2022, 2023, 2024. Well, actually, you wouldn't count 2024, so you have an extra year actually from 2019 is how they would look at it. Because it's based upon the end of the tax year, which is December 31st of the previous year, right? That's how it works. So 2019 to 2023 is what you would have. 2019 is the first year, 2020 is the second year, 2021 is the third, 2022 is the fourth, and then 2023 is the fifth year. So you would have to live in the house for any of these 2 years in order for you to qualify right now. What that gives you is $250,000 of untaxable capital gains. What does that mean is, so you bought it at $500,000, and now in 2024, you want to sell it. You lived in there from 2020 to 2021, right? Let's say you rented it out in 2019, but 2020 to 2021, you lived in there and you were selling the house for $750,000. You would pay zero taxes on the capital gains because you're under that threshold. And if you are married, actually, you get to capitalize on that at $500,000. So meaning if you bought the house for $500,000, your cost basis is $500,000. Let's assume that. And you're selling for $1 million and you're married, then you pay no taxes on the capital gains. That's just how it works, simple math. There's a lot more complications to it. I'm hoping that you're understanding the concept. But now let's say you lived in the house for the 2 years, but you're selling it still for the $1 million, but you're not married. So therefore, your capital gains, the profit, right, is $500,000. So you'll be paying taxes supposedly on the $500,000. But before you do that, they have to take out your $250,000 of untaxable capital gains because you stayed in it for 2+ years within the last 5. So therefore, you would only be paying taxes on the remaining $250,000. And let me do a different math so that way you understand it. Let's say you were selling for $800,000. So I bought it at $500,000. The first $250,000 untaxable. Up to $750,000, I pay no taxes. Now from $750,000 to $800,000 is a $50,000 difference. That's the only taxes I'll be paying on, just the $50,000. That's how that rule works. If you lived in it in 2020, didn't live in it in 2021, but lived in it in 2022, that still counts as 2 years. And I only know about this because my friend was in the situation and I had to ask my accountants, he had to ask his accountants, and that's how we were able to understand that rule because it's not so clear inside of the IRS websites. If you are a homeowner who's renting part or all of a home or your home, do not forget your repairs. Right? All the repairs that you did from the house, make sure you have everything itemized. They either go into supplies, repair, maintenance, legal fees. There's different categories that the IRS has. Even advertising too. Like if you have to list your property, pay the realtor, put it on Facebook, those will count as deductions for the home. So don't neglect those at all. What I love about owning a home, even if it's a 2-family, you're renting half of it, you're living in half, you get all these great tax benefits. Like for me, I get a tax depreciation value of around $14,000, I believe it was last year, per year for doing nothing. That's based on, of course, some of the expenses I accrued doing repairs in the house, but also based on the value that the IRS is looking at the home to have. And what they do is they let you depreciate the value of the home over 27.5 years. That's where that $14,000 credit that I'm getting automatically is coming from. That's called the home depreciation deduction. So you have that, plus the repairs that you did that year for the home. You bought a new stove, a new fridge, you had to fix this closet. All these things you actually get to deduct. Even the utilities that, let's say you're paying for the tenants and they're not paying it themselves, you get to deduct all that as well. So all these things you get to minus. Speak to your accountant to figure out exactly what applies to you because not everything is applicable to everybody. You could do the home office deduction, and this applies to both W-2 and 1099 as well. If you are forced to work from home as a W-2 employee, and let's say you use like 25% of a space as an office, and this has to be a dedicated space. 25% can be ridiculous depending on the size of the space because there's all these limitations, so I didn't do that. in order for me to get that deduction. But I was able to get everything else. Pretty much it made more sense for me to claim the utilities rather than me claiming the actual home deduction, because it's a little bit more complicated and it reduces what you can deduct elsewhere as well. It's very complicated. Don't believe the hype and everybody tell you, don't forget your home office deduction. Like, it's gonna work perfectly every time. Not everything works for everybody in that way. The Augusta rule is another thing. Again, I couldn't do this because it did not make sense for me to do this because of the amount of utilities that I had to pay. I'm in the technology space, right? So my utilities are going to be high. I got to get like the top graded business internet speed and all these things in order for me to make sure that I can deliver to clients at an optimal grade at no point in time with no issues with my technology. So therefore, I'm going to pay a little bit more. So it made more sense for me to deduct those rather than applying the Augusta rule. So that Augusta rule is you have 14 days out the year you can rent out part of your home to your own business, right? And you're deducting it, like, let's say $200 is the going rate for that part of your home. So you do 200 times 14 and see what that number is, and it's like $2,800. If you're in a more expensive area, right, you're probably doing $400 per day times 14. That would be $5,600 that you can actually get untaxable, and you also get the deduction. You don't pay taxes on the $5,600. But you also get a deduction of the $5,600 from your taxes. It's a beautiful rule, but it doesn't work for everybody every time. It all depends on these things. For me, it couldn't work because of the fact that my utilities outweighed that, and I couldn't really do both. So it made more sense to go that route. If you are starting a business, brand new idea, first year that you started a business, so let's say in 2023, you started this business, you have all these expenses. Those are called startup costs. You could deduct all that against your W-2, 1099 income. The government lets you do that. Up to a certain income threshold, though, it becomes more complicated. Although I'm telling you this, you got to speak to your accountant because there are limitations to when you can actually use this fully. If you're in business second, third year, you could still do this. But after your third year, I strongly advise do not claim negative net return on your business for the past 3 years consecutively. What happens is the IRS now look at you as a hobby and you're not going to be able to deduct anymore, right? So at least on your third year, try to see if you can gain some profits, because at that point, they'll see that you've been trying and everything. Like, business is tough. Starting a business it's a challenge. You got to put a lot of time, effort into it, and you can never predict your time to profitability. But if you keep working on it, the IRS does give you like 3 years of trying to establish this so you can bring more return. Because most of the U.S. economy is run by small businesses, believe it or not. So the more small businesses that they have established, they encourage that, the more that it helps the economy be much more stabilized. If you go into the casino or hit the lotto and you played all these numbers or all these games and you had a huge, nice win of capital gains, then you're going to have to pay capital gains tax on that. But if you kept track of all the losses that you had, you can offset that so you can reduce the amount of taxes that you're paying because you've made this in a business, right? This is kind of like your gambling business. I invested money, time, tickets, whatever into this. Even though my gains is way higher than my loss, but I still have some losses which I can help reduce my taxes. So these are the 10 things that I really think you can leverage for 2023 to help reduce your taxable income, have more money in your pocket so that way you can have more to invest in so we can rock out the years to come, not just this year, but for all the future, have businesses growing. The more money you can keep, that's what it's really about. It's not about you earning all this high income. It's more about how much of it that you can actually keep. So peace and love. Hope you found this insightful. Trust in Jesus. Have an amazing one. Thank you so much for checking out my video. My goal is to be able to share as much knowledge, wisdom, experience that I've been given, privilege from God over the years to be able to give that to you and also be able to receive from you as well. This can definitely be a two-way dialogue. It doesn't have to be one way at all. It's just for us to be engaged. And I'm just continuously sharing as things that I'm seeing move along the market. So I hope you find insights, and your feedback is greatly appreciated as well. How can you support me? Right now, I have these wristbands. You can get them at luxury.com. I've been selling them on eBay for quite some time. it just says make your statement. It's just a encouraging, inspirational message. You can purchase these right now, available on there. Eventually it will be spun off to other things and I'll have other products, but that's one way you can do right now. But most importantly is just making sure you receive something from the content I've given. And if you have any feedback, that is probably the most valuable thing I could say you can give to me. So I appreciate it, and I hope that we can continue to build a long-term relationship with each other and just grow with one another. Peace. And if you have any questions, definitely drop it below.
Hustle, 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 step.